Chapter 19, Sharia Governance and Compliance, Approval Layers, Audit Trails, and Change Management Constraints. This chapter examines the critical governance and compliance framework that underpins Islamic corporate banking. We explore the approval layers, audit trail requirements, and change management constraints that ensure all Islamic finance operations remain Sharia compliant. For Ijara, the system generates a detailed rental schedule. For floating rentals, it must support versioning, allowing for recalculation of rental amounts at rate reset dates. This recalculation must strictly follow Sharia-approved methodologies. The leased asset remains on the bank's balance sheet. Rental income is recognized over time on an accrual basis. If a title transfer occurs at the end of the lease, the asset is derecognized from the bank's books. Musharaka is a joint investment contract where both the bank and client contribute capital and share profits and losses based on pre-agreed ratios. It is a true equity-like instrument embodying risk-sharing and entrepreneurial spirit. The Musharaka transaction flow begins with an agreement to co-invest. Both parties contribute capital. The bank's contribution represents a financing exposure akin to equity. Profits are shared according to agreed ratios, which do not have to be proportional to capital contributions. However, losses are strictly shared according to capital contribution. Over the project's life cycle, the bank may gradually reduce its share through buy-downs by the client. This effectively converts the bank's exposure into increased client ownership. Musharaka fundamentally differs from conventional debt. There is no guaranteed return on investment. Profitability is directly tied to the underlying project's performance. The bank takes on direct business risk, not just credit risk. From a system viewpoint, Musharaka requires an investment position object that tracks the bank's capital contribution, the agreed profit share ratio, and the mechanism for partner buy-downs. The system must facilitate periodic calculation and allocation of profits based on the project's results. For all three structures, systems must support document-centric flows to provide comprehensive Sharia audit trails. For Murabaha, this includes purchase orders, purchase contracts, sale contracts, and client acceptance. For Ijara, this includes asset purchase documents, lease agreements, insurance contracts, and handover documentation. For Musharaka, this includes partnership agreements, capital contribution records, and profit distribution agreements. Sharia audits focus on contract presence and sequence. Are all required contracts present, and were they executed in the correct sequence? Do system records accurately match the approved Sharia structure? Are there any prohibited clauses or interest-like terms present? Systems must provide Sharia and compliance teams with clear visibility into contract flows and parameterization, not just financial balances. Change logs for parameter adjustments must be transparent and linked to proper approvals. While Islamic products are structured differently from conventional ones, the underlying principles of impairment and non-performing loan logic align conceptually with conventional banking practices. Sharia governance ensures that all Islamic finance operations maintain religious compliance while meeting regulatory and business requirements.